A Bitcoin ETF that pays you 15 to 20% a year. That's the pitch showing up across Wall Street in 2026. Income funds built on Bitcoin, advertising yields that dwarf almost anything in the bond market. But here's the problem. Bitcoin pays nothing. No dividend, no interest, no staking reward, the way Ethereum or Solana have. So if the asset underneath produces zero income, where does a double-digit yield actually come from? The answer is a strategy called a covered call, and it's the engine inside every one of these funds. Here's how it works. The fund holds Bitcoin, usually through a spot Bitcoin ETF it owns shares in. Then it sells call options against a chunk of that Bitcoin. A call option is a contract that gives someone else the right to buy your Bitcoin at a set price, before a set date. They pay you a fee, a premium, for that right. The fund collects those premiums month after month and pays them out to you as income. That's the yield. It isn't coming from Bitcoin. It's coming from selling other people the right to your Bitcoin's upside. And that's the catch the headline number never mentions. When you sell a call, you're agreeing to a ceiling. If Bitcoin sits still or drifts up slowly, the options expire worthless. You keep every premium, and the strategy looks brilliant. But if Bitcoin rips, a real bull run, the buyer exercises their right, and the fund hands over its Bitcoin at the lower agreed price. You collected your premium, but you missed the move. The income was real. So was the upside you sold to get it. This is why these funds do best in a very specific kind of weather: sideways, choppy, or only mildly bullish markets. High volatility actually helps, because nervous markets make options more expensive, which means fatter premiums and bigger payouts. The irony is hard to miss. The same volatility that scares people out of Bitcoin is exactly what these funds are built to sell. There's a reason this structure showed up for Bitcoin when it did. Ethereum and Solana funds can generate yield a cleaner way, by staking the coins they hold and earning protocol rewards. Bitcoin has no such mechanism. It just sits there. So to manufacture income from Bitcoin, issuers had to reach for options instead. BlackRock launched the first yield-generating Bitcoin ETF in 2026, and a line of competitors followed within months, with more on the way. The label varies: premium income, covered call, buy right. But under the hood, they're all running the same trade. So what separates a good fund from a bad one? Start with the distribution rate. It is not a guarantee. It moves with volatility, and part of what you receive can simply be your own capital handed back to you, dressed up as yield. Then there's cost. These funds charge more than a plain spot Bitcoin ETF, because someone is actively managing the options. And then there's the lag. The deeper into a bull market you go, the more you will watch the fund trail the very asset it holds. Income on the way up always costs you the climb. So, are these worth it? It depends entirely on what you came for. If you want monthly cash flow, and you think Bitcoin grinds sideways, a covered call ETF turns that boredom into a paycheck. If you are here for the moon, you are paying to give it away. Because in the end, a covered call ETF does not pay you for holding Bitcoin. It pays you for agreeing to sell Bitcoin's best days. That can be a smart trade, as long as you know that is the trade you are making. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.